everyone. So this video is by popular demand. I recently made a video about buying versus renting property in London and why buying is not always the right financial choice. And I had a lot of people ask me, can I make a similar video about buying or renting property in South Africa and specifically in the Western Cape. So what do we have on the agenda today? First, we'll look at two real life examples of buying versus renting. When does it make sense to buy? When does it make sense to rent? And then we'll look at the rule of 8.5%. I've created a dashboard to help you determine at which point it's better for you to rent than buy a property. And I did that by putting a buyer of a property and a renter in the same cash flow position and allowing the renter to build up an investment portfolio instead of buying a property. And by doing this, I've established a break-even point of 8.5%. And this is basically a rule that you can use to determine at which point it's better for you to rent a property than buy one. Just a quick introduction about myself. So I'm a chartered accountant and I've got an MBA from IMD Business School in Switzerland. I've also got 10 years of experience in the finance and investment industry. Right now I live in Zurich in Switzerland, but my experience specific to South Africa is that I still oversee client property portfolios in South Africa. I've started a wealth advisory firm and many of my clients are South Africans and I travel to South Africa very often. So just one thing to be clear, the purpose of this video is to analyze whether it's better to buy or rent a property. And it's not to look at property from an investment point of view where you're the landlord and renting the property out. I think the common misconception that buying a property and living in it is always better than renting a property comes down to a few reasons. First of all, people see renting as throwing money down the drain and basically paying the landlord's mortgage off. They also think that owning an asset after a 25-year mortgage is better than paying rent for the rest of their life. And there is also a sort of a FOMO because people always hear about how crazy property prices have increased, but they very rarely consider how stock prices have increased. So there is an opportunity cost when you invest in property because the money that you put down as a deposit or that you build up in equity in the property over years could be considered as an opportunity cost of not investing in the stock market. But we'll look at this in detail just a bit later. I'm focusing on Cape Town and the surrounding areas because it was the most requested by my Instagram followers and comments on the previous YouTube video. But if you want me to also do this with a different area, let me know in the comments and I'll do that if there is enough demand. The Western Cape is a province in which the city of Cape Town is located and it has in the last few years experienced an influx of foreigners working remotely from South Africa or retiring there and also a semigration movement of South Africans that are more up north moving down to the Western Cape. The city of Cape Town also has the highest average for residential properties in South Africa by far. Okay, so now let's get to the numbers. Just a brief background on how I approach this analysis. When you buy a property, we're going to assume in this case you take on a 25-year mortgage. You will have cash flows related to your monthly mortgage. You will pay levies if your house is in a security estate. There are property rates and taxes to pay, and there's also repairs and maintenance payable. So we're going to forecast the cash flows of a property buyer for 25 years. And then on the flip side, we're going to take a renter and the amount of rent that is going to pay every month and every year for the next 25 years. And all of the cash flows that the buyer of the property spends in excess of the renter, we're also going to allocate to the renter to make sure that we put both in the same position in terms of cash flows. But the renter is going to invest his excess cash flows in the stock market. And then we'll look at in 25 years how the property versus the investment portfolio performed. And we'll also look at after 25 years when the renter still has to pay rent, but the buyer has property that he can live in to see what it'll look like after 40 or 50 years. To be able to make this comparison as reasonable as possible, I tried to find two properties that are almost exactly the same, but one is to buy and one is to rent, so that we can have some objective data to compare. For this, I spent a lot of time on Property 24 to look for two properties that are almost identical, and I tried to find a family house with 3 bedrooms. I couldn't find any in Cape Town, so I actually had to look a little bit outside, and then I found two properties, one to rent and one to buy, just outside of Cape Town on a security estate in Somerset West. So now we'll look at the two properties on this estate, and in the next example, we'll look at an estate in Paarl where the property prices are actually much more expensive. So in this example, both properties have 3 bedrooms, one has 2.5 and the other one has 3 bathrooms, and they both have very similar property and floor sizes. One is to rent for 33,000 Rand a month, and one is to buy for just over 4 million. So just a small note here. In this case, we want to determine whether buying or renting is better. So first, let's start with the buyer's cash flows. If we use Property24's online bond calculator, we assume a 10% deposit and a 25-year mortgage. The interest rate I'm actually going to change because interest rates are quite high at the moment and we're on the upper end of the interest rate cycles. We're expecting interest rates to be cut in future, and because we're trying to forecast a 25-year mortgage, I think it's better to use an average mortgage rate. So luckily on the South African Reserve Bank's website, which sets interest rates in South Africa, I could extract the prime lending rate since 2002. So I calculated a 22-year average of 10.67%. In South Africa, it's quite common that when you put a 10% deposit down, the bank will issue you a mortgage for less than prime. So I'm going to assume a mortgage at prime less 1.25%, which is 9.42%. So if we put the deposit and the interest rate into the bond calculator, our monthly repayment is going to be 32,776 Rand. There are also other once-off costs when you buy the property that needs to be considered in the cash flow, and that would be 812,000 Rand, which includes the 10% deposit, the transfer duty, and other once-off costs. So we've got the mortgage payments for the next 25 years. Then we also add repairs and maintenance, which is a cash flow that the property owner is responsible for. And a widely used rule of thumb is 1% of the property value. The rates and taxes and levy amounts were also given on the Property24 website. So I've annualized those, calculated them at a percentage of the property value, and forecasted that for the next 25 years based on the property value increase. And then we get the total annual cash flows of the property buyer. So let's look at the cash flows of the renter. In the renter's case, the monthly rent is 33,000 Rand, and an upfront deposit equal to 1 month's rent is also payable at the start. So to put the buyer and the renter in the same position, we'll also allocate the initial cash flow that the buyer spent to the renter, and the amount that the renter will invest is equal to the upfront costs less the rental deposit payable by the renter. So by how much are we going to increase the rent every month? I really struggled to find long-term averages on rent increases in the Western Cape. But thanks to PayProp, which is property management software available in South Africa, they very kindly shared rental price increase data for the last 12 years with me. And I was able to calculate an average rental price increase in the Western Cape for the last 12 years of 6% per year. I also did some crowdsourcing of information, and I asked my Instagram followers that live in the area to let me know what their annual rent increase has been over the last few years. And the most popular answer was 7 to 8%. So in this case, I'm going to go with 7%, which is in the middle between the external data and the crowdsourced information. So to put the renter in the same cash flow position as the buyer, we're going to allocate the difference between the cash flow of the buyer and the renter to the renter, and he will invest that. You'll notice in year 6, the rental amount has increased so much that the renter actually has to start withdrawing from his investment to make sure that he can pay his rent. You will see that at the end of 25 years, both the renter and the buyer have spent the same amount of cash. So let's look at what the buyer's property and what the renter's investment portfolio will look like in 25 years. First, we have to determine by what percentage the property value is going to increase every year. And again, I was quite happy to get some good long-term objective data. The Statistical Department of the Government of South Africa issues a residential property index, and from that I was able to calculate an annual average price increase in the city of Cape Town since 2010. So the 13-year annual average is 9.67%. So we forecast that the property's value will continue to increase by that every year, and by the end of 25 years the property is worth 42 million. So let's look at the renter's stock portfolio that was built up. First, we'll assume that he invests in a diversified global ETF, and in this case the Satrix MSCI Index Fund, which has a 10-year average annual return of 14.27% in Rand terms. And you can see by year 6, he started withdrawing from his investment portfolio. And by the end of 25 years, his portfolio was worth only 13 million. And after 25 years, of course, the renter still has to pay rent, and the buyer has paid off his mortgage, and now he's only responsible for repairs, maintenance, levies, and rates and taxes. And we can extend the forecast on the property value and the renter's stock portfolio up to 50 years. And in this case, the buyer is clearly much better off than the renter. But if we assume that the renter had invested in an S&P 500 index ETF, which has earned returns much higher than the MSCI All World ETF, the returns were 18.72% since inception. The renter's stock portfolio, despite him withdrawing some funds from that to be able to cover the cash flow deficit he needed for rent, looks much better than the property value, as you can see on this chart. By year 40, the renter's stock portfolio is actually worth 500 million rand more than the property. And that's despite him withdrawing funds to cover his rent. But using the S&P 500 returns, although this is a broad index covering the stocks of 500 companies in the US, I still feel like that is a bit cherry picking. So I would prefer in this analysis to focus on the MSCI All World Index returns, although they have been a bit lower. And of course, none of these historic returns can guarantee that's what's going to happen in the future. And that's the same with the property increases, but we want to use some data that's broad and long-term averages to try and do some forecasting to help us with decision making. So the point here is that in this case, because the rent is so high on this property and the renter will not be able to contribute that much to his stock portfolio that's invested in global stocks, I think in this case it would actually be smarter to buy the property than rent it. But it's not always the case. So in the next example, I'll show you what it looks like when it's not a good idea and when it's actually better to rent than buy. But before we move on to that, I just want to mention two things. The first thing is that all the amounts and the forecasts that I use are in nominal terms and not in real terms. And that basically means that if we're thinking of this money in the future and we actually want to compare it to what it would be worth in today's terms, we will need to discount it by expected inflation to get what it would be worth in real terms today. But I didn't want to complicate this calculation too much. And the last thing to consider, usually when property prices increase a lot for certain types of houses or in certain areas, property developers will take advantage of that gap in the market and they will start building to meet the increase in demand. So usually exceptional returns are short-lived until enough competitors have taken up the space and built alternatives to bring down increases in property prices. Or it might reach a saturation point where people say it no longer makes sense to buy and they might actually move further away or relocate to different towns or cities. So that's just some food for thought. But let's look at the next example. Here I found two identical properties on a security estate just outside of Paarl, which is a big town about an hour away from Cape Town. The two properties both have 3 beds, 2 bathrooms, and they are almost identical in property size. One is to rent for 35,000 Rand a month and the other one is to buy for 7.5 million Rand. So now we're going to look at what it looks like from a buyer's point of view and what it looks like from a renter's point of view. Again, we'll approach the cash flows for the buyer in the same way. We'll use the long-term prime rate, less 1.25%, and that's an interest rate of 9.42% for a 25-year mortgage and a 10% deposit. So the upfront cash flow for the buyer is 1.5 million Rand. Then repairs and maintenance is 1% of the property's value. Rates and taxes and levies are also available on the property website, and they are in line with the previous percentages I used. So they will also be forecasted at 0.5% and 0.8% respectively for the next 25 years. On the renter side, I have asked around a bit and I believe that rent increases in this estate have averaged around 9% a year. So I forecasted the rent for the next 25 years to be increased at 9% a year. Although I think if we really have to objectively do a long-term average, it would probably be less than 9%, just because when we include some data during periods where the rental market was not as hot, it will bring down the average quite a bit. But I want to be conservative and also realistic in this analysis, so I'm using a rent increase of 9% per year. And again, in this case, we allocate the same cash flow that the buyer has access to the renter, and the renter is going to invest the excess cash flow that the buyer has access to, so that we put them both in the same position. And for the renter's cash flows, you will notice that the renter makes an initial investment of 1.5 million, which is equal to the deposit and upfront costs that the buyer has, less 1 month's rent, which is payable as a deposit. And then we forecast the rent for the next 25 years at a 9% increase. And at the end of 25 years, both have spent the same amount of cash, which is equal to 35 million Rand. And you will see by year 14, the annual amount of rent due actually exceeds the cash flows of the buyer. So From year 14 onwards, the renter starts withdrawing from his investment portfolio. Now, let's look at after 25 years what the property value looks like and what the renter's stock portfolio looks like. So again, we're increasing the property's value by the 13-year average of the residential property price index in the city of Cape Town, which is 9.67%. And the property goes from 7.5 million rand to almost 10 million rand in year 3. That looks like quite a good return, right? And by the end of 25 years, the property is worth 75 million rand. That really looks good. But let's look at what the renter's stock portfolio looks like. So all of the excess cash that the renter had access to, he invested in a stock portfolio. And again, we're assuming a global diversified ETF, which tracks the MSCI All World Index, and it has an annual average return of 14.27% in Rand. We forecast the stock portfolio to grow by this every year, and you will see by year 14, the renter actually starts withdrawing from his stock portfolio to be able to cover the shortage in cash flow. But by the end of 25 years, the renter's stock portfolio is worth 101 million Rand. So that's 26 million Rand more than the property value. But I'm sure you must be thinking that after 25 years, the property owner has paid off his property, where the renter still has to pay rent. So let's look at the cash flows from year 26 to year 50. The buyer will still be responsible for repairs and maintenance, estate levies, and rates and taxes. And the renter's rent still increases 9% every year from year 26 to year 50. And still, we're allocating the same amount of cash that the buyer has access to the renter, but now that the rent payable is higher than the cash flows of the buyer, the renter will actually withdraw from his investments to be able to cover that cash flow shortage. So let's look at what the renter's stock portfolio looks like from year 26 to year 50. You will notice that he needs to withdraw quite a lot from his investment portfolio to be able to cover his rent. But because his returns in the stock market is superior, he's actually able to cover his rent and reinvest money into his stock portfolio. So the compounding impact of the superior returns of the stock market in this case actually puts the renter, despite him having to withdraw to cover his rent, in a much better position than the buyer of the property. Because by year 40, the renter's stock portfolio is worth 600 million, where the property's value is 300 million. So the renter's portfolio is worth 300 million Rand more. By year 50, whoever is still living there by 50 years, the renter's stock portfolio is worth 1.3 billion Rand more than the property's value. Okay, so there are quite a few variables here, but don't worry, I'm going to address them. Some people will say that the properties in this estate have increased much more than the 9.76% 13-year average that you use. I think the flaw with this argument is that people don't collect enough data points, and also focusing on a few success stories is like cherry picking, similar to using the S&P 500 returns like I showed earlier to model, and that would clearly beat any scenario that we present on this chart. But I'm still going to model a scenario where the property prices increase by a multiple of 1.2x, so 20% more than the average that I've used. And that's an 11.6% annual return in this case. And in my opinion, it seems unlikely to achieve that for the next 25 years, but let's do it anyway. So even if we forecast it like that, the renter will still have 216 million more in his stock portfolio by year 40. And that's still using the returns of a globally diversified ETF. And if you think these returns are unattainable, I would invite you to look at the other videos on my channel and also follow me on Instagram, because I really would like to empower people to make better investment decisions. And I want to be able to help people build more wealth. So what if the renter invested in an S&P 500 index ETF? The renter will have 2 billion Rand more by year 40 than the value of the property. The exponential effect in this case is insane. But again, just focusing on returns of the US market is a little bit cherry picking in this case. So I just wanted to show you how crazy the compounding impact of returns can be, because by year 40, the renter's portfolio would be worth 2 billion Rand more. So now for the really interesting part. I've showed you two scenarios where one, in my opinion, it makes more sense to buy a property, and in the second scenario, in my opinion, where it makes more sense to rent the property. But how would you know what the right choice is? It's obviously a factor of many things, but the rental price and the price of the property plays a big role. And I'm going to help you establish a break-even rule. If you've come this far, you're obviously enjoying this video, so I'll invite you to subscribe to my channel and follow me on Instagram to see more of these kind of videos in future. And if you're serious about building more wealth for yourself, then you're at the right place. So now, a drum roll, please, for what I call the rule of 8.5%. So what I've done is I've created a dashboard to easily see what the value of a property of a buyer looks like compared to a renter's portfolio, taking everything into consideration that I've mentioned before. So what I'm trying to do here is when you have a property and you're trying to determine whether this property is better to buy or to rent, I'm going to establish a rule that you can use. So the first example I'm going to use is if you have a property worth 5 million rand and renting a similar property would cost you 8% of the property value, which is 400,000 Rand a year and 33,000 Rand a month. If we put the renter stock portfolio and the value of the property on a chart over time, you will see that the renter's stock portfolio is more valuable than the buyer's property. So therefore, in this case, when rent is equal to or less than 8% of property value, it would be better to rent the property because very clearly the renter is in a better position in the long term. So now let's look at 9%. If the rent payable on a property is equal to 9% of the property value, so let's say the property's value is 5 million Rand and the rent is equal to 450,000 Rand annually, which is 37,000 Rand 500 per month. And in this case, the renter's stock portfolio is much lower than the property's value in the long term. So if the annual rent on a property is higher than 9% of the property's value, it clearly does not make sense to rent. It's better to buy in this case. So that helps us establish the 8.5% rule. If a property's value is 5 million Rand and it's to rent at 8.5% of the property's value, which is 425,000 Rand a year and just a bit more than 35,000 Rand a month, you will see that at year 44, there is a break-even point where the renter's stock portfolio exceeds the buyer's property value. And that's how we establish the 8.5% rule, which basically means that if you look at a property's value and you calculate 8.5% of that, that's the annual amount of rent, and you divide that by 12, that would give you a break-even point. So if the monthly rental is less than that amount, it's better to rent the property. And if the monthly rental is more than that amount, it's better to buy the property. And we can also apply this to other values to make it easier for you to understand. If a property's value is 4 million Rand, 8.5% of that is 340,000 Rand a year. And that is 28,300 Rand per month. If you can rent a similar property for less than 28,000 Rand a month, it's better to rent. And if rent is higher than 28,300, it's better to buy the property. Let's also apply this to 3 million Rand. 3 million times 8.5% is 255,000 Rand. Divided by 12 is 21,250. If you can rent a property of 3 million Rand for less than 21,250 a month, it's better to rent the property. But if the rent is higher than 21,250, it's better to buy the property. Something that's crucial in this rule is that the renter invests in a global stock portfolio. Because if the renter invests in an ETF tracking a South African index called the JSE All Share Index, this has a 10-year average return of just over 7%, which is almost half the return of the globally diversified stock index I mentioned before. And this is what the renter's portfolio would look like over time. So if the renter doesn't make smart investment decisions, their long-term position is clearly not going to be better than the buyers. If you want to learn more on how to be a better investor, you can reach me on Instagram at moneywithcarla, and I'm always happy to help. There are also many other considerations and arguments for and against buying a property, but I discussed those at length in my previous video if you are interested in seeing more of my opinion on that. And also something else that would impact this calculation is the tax considerations, because capital gains tax is a tax that's payable on the growth of investments. And on your primary residence, there is a primary residence exclusion, which excludes a portion of your gain from tax, where on your investment portfolio, only the portion that's invested in a tax-free saving account wouldn't be taxed, but the rest would be subject to tax. If you want to learn more about how to be smart tax-wise with your investments, have a look at this video that I did specifically on that. If you're interested in seeing more of these videos, subscribe to my channel, and I look forward to seeing you next time.